welcome to everybody. It's great to see so many friendly and familiar faces on the screen. So let me just quickly introduce our speaker and also our discussant. Not that I suspect Valpy needs much introduction to most of you on this call. Diego will say something about Valpy's academic work and credentials. Let me just say a few things about him as a colleague. Valpy has been a colleague of mine for, I know almost exactly, I think you arrived, Valpy, in October 1992 at St. Anthony's as a fellow. And I know that because I arrived in April 1992, and therefore you stopped me being what was known as the junior fellow. And people won't believe this, but it used to be the custom that the junior fellow had to take the minutes in the governing body meetings. And I was thrilled when Valpy arrived, not just because he was a great colleague, but because he could also take over one of the duties that I did not enjoy doing. Valpy's got a fascinating history, even more fascinating than I realized. I just came across recently an article which I strongly encourage people to read. It's written by our now much missed colleague, John Toy, called Valpy Fitzgerald, Radical Macroeconomist of Development, published in Oxford Development Studies in 2017. And it told me more things about Valpy than I had ever known in the 30 years that we've been colleagues. I didn't know, Valpy, for example, that you originally intended to study chemical engineering rather than PPE. The world would be a very different place if you had done that. I didn't know you had got married in the great mosque in Cordoba. I didn't know that you had worked at the Economist Intelligence Unit and used to write for The Economist. I didn't know that you were the only supervisee of your doctoral supervisor, which must be a fairly unusual experience. And I didn't remember the whole story about you going to advise the Sandinistas in Nicaragua on how not to repeat the policy errors by the revolutionists in Cuba, Chile, and Peru. And what a story. Colleagues, I strongly encourage you to go and read it, and then you'll find things about Valpy that perhaps even he had forgotten in his past. And before I pass you over to Diego, just to say, Valpy is currently working on a fascinating project, which is the history of QEH. He's published 3 articles so far in Oxford Development Matters, and they're just a little sort of amuse-bouche, a taster of the book that he's putting together. When you've read the articles, you'll be waiting for the full book, and we all wish you well, Valpy, on completing that project, hopefully in the near future. Rodrigo Cubero, Dr. Rodrigo Cubero is our discussant today. He is one of Valpy's most distinguished supervisees. He was the governor of the Central Bank of Costa Rica. He took up that post in 2018, and he's just told me he stepped down last Sunday, which is why he's looking so cheerful. Now I understand it, but he has done obviously a very important role there. He did his doctoral work in Oxford with Valpy. He worked for a long time at the IMF with various positions, including one as a team member for Costa Rica, El Salvador, New Zealand, Malaysia, and Singapore. And I've long puzzled what the connection was between those countries and why you covered those particular countries. He's been a fantastic friend of St. Anthony's, and it's fabulous that he's agreed to be a discussant this evening. So let me pass you quickly over to Diego. I think we'll say a few words about Valpy's academic and intellectual contributions, and then we'll let Valpy have the floor. Diego, over to you.
Thank you so much, Roger. It's actually great to be here, primarily to hear Valpy, but also to have Rodrigo coming back to St. Anthony's, even if it's online. So you have said most of what is most interesting about Valpy, but let me say a little bit about his life, starting for what is more meaningful to me. Valpy was actually head of the Oxford Department of International Development when I came to Oxford. He was the one encouraging me to apply to the job, so I owe him the job in some ways, but also he has become a reference in Spain, my own country, where he has actually contributed to shape macroeconomics in many ways and influenced many young researchers. So of the many things I value and admire Valpy for, that as a key. He read PPE at Oxford, but then actually went to do the PhD in Cambridge. And as you said, Roger, welfare at the economist. Then he was the assistant director of development studies at Cambridge, and moved to the Institute of Social Studies in The Hague, which is one of the key departments of development in the whole Europe. He came back to Oxford to join St. Anthony's. I didn't know that the same year as you, Roger, in 1992, and at Queen Elizabeth House, which he became the Oxford Department of International Development, who he led for several years before retiring, and who he is writing now the history of, and no one better to do that. And where he's now a professor, a fellow emeritus, and has helped us in many projects, including the preparation of the REFT, which we submitted last year. Of course, during his time in Oxford, he was not just at QEH, but he was an integral member of the Latin American Center Management Committee and collaborated closely with Rosemary Thorpe and others in strengthening the contribution that Oxford has had to economics and political economy of Latin America for a long time. His current research interest includes the macroeconomics of income inequality and long-run economic development in Latin America. And as I said, he's writing the history of QH. But more relevant for today, Valpy has worked on theory and practice of international tax reform, starting when he was an advisor for the UK DFID between 1997 and 2002. I'm told that, Rodrigo, you were actually the research assistant of that project on multilateral agreement on investment. So there's another connection to what we are going to discuss. Of course, Valpy is not going to talk about all of this just in theory. He has been very active in participating in policy debates as commissioner of the Independent Commission on the Reform of International Corporate Taxation, which is chaired by another person with long links to St. Anthony's, Jose Antonio Campo, and is the basis of that work that will be used for the presentation today.
Well, thank you very much, Diego. Yes?
Yes, please go ahead, Valpy.
Right. Well, the topic is about reforming global corporate taxation. I will try to, given that it's quite late already tonight, to stress, if you like, the political and conceptual issues around this, rather than delving into too much detail about taxation as such, because I think it's an interesting story. The issue faced by the governments of the world is that ever since, I suppose, the 1980s, the opening up of global capital markets has meant that countries are competing for foreign investment. And one of the results of this has been a race to the bottom as countries reduce their tax rate against each other in order to attract investment. So in fact, corporate tax rates have fallen by 1/2 since 1980. In addition, the multinational corporations, particularly the digital giants such as Google, have increasingly shifted their income around the world in order to avoid paying tax at all. In other words, shifting their profits to tax havens when they can. The consequence is that the governments of the world have lost $500 billion each year in tax revenues, according to the estimates made by the International Monetary Fund. The smaller countries and poorer countries have been especially vulnerable to this process because they rely disproportionately on foreign firms for investment and technological change, and also they feel pressured in offering very large investment incentives to foreign firms. In effect, this is a textbook case of coordination failure between governments, because there is a sense in which this is almost a zero-sum game with countries competing to lower their tax rates, that this doesn't really increase the amount of global investment significantly. And the welfare costs in terms of foregone tax revenue and consequence the capacity to educate and support the health of the populations has been severely undermined. Just to look at this, this is a graph from the IMF's Fiscal Monitor. Here you can see how all countries have followed a very similar track, with the low-income countries, which are most dependent on taxation of foreign firms, lagging behind, but still having their tax rates more or less halved between a global average about 40 or 45% down towards 25% today. The consequences of this are, there are more IMF estimates, where the OECD countries in the blue column are the richer countries, are losing something in the order of 400 billion a year, and the developing countries are losing something in the order of about 200 billion. On the other hand, so the losses are much larger to the developed countries than the developing countries. On the other hand, if we look at this as a percentage of GDP, you can see that the yellow bar, the developing countries, are disproportionately hit as a share of their GDP compared to the OECD countries. So the burden is large and it's disproportionately broad. Now, Diego had mentioned the Imprints Commission. This commission was established in order to help particularly poor countries lobby to try and rectify this position. The commission was set up in order to provide authoritative technical support to global civil society advocacy for just and effective tax systems and engage effectively in a global policy debate. The reason why is because the poorer countries and also the international civil society organizations such as Oxfam have been campaigning on tax issues for some time, but with very little traction because they didn't have the technical capacity to critique the proposals and also to propose alternatives that were, if you like, viable. Right? So there was a gap, if you like, of how to increase the power of advocacy by increasing its technical content. So it was set up with a number of stars, including Joe Stiglitz and Piketty on this commission. There were two former finance ministers, Campo was an Antonian from Colombia and Swan from Australia, a number of activists and tax experts from the global south, a number of retired tax authorities, and as I said, two Antonians, that is Campo and myself. Without going into too much detail, the position that the Commission has taken is firstly that corporation tax on excess profits, that is monopoly profits if you like, does not need to harm investment or employment, so that the welfare cost of increasing tax rates would not be great and more than outbalanced by the welfare benefits. Secondly, the taxing rights should be apportioned by economic presence. In other words, that global corporations should pay tax where their activities take place, production or sales and so on, and not in some tax haven in Luxembourg or the British Virgin Islands, where they can actually book their profits. The third proposition is that a global minimum tax rate should be set with a floor on tax rates, which we have suggested should be 25%, which is just the present global average. In other words, to stop the race to the bottom. So those are two things which we've been campaigning for some 10 years now, and as you'll see, there's been some traction. Obviously not just because of the influence of the Commission, but also because of the circumstances I'll try and explain. So what's been the response? Well, in 2012, the G20 had mandated multinational negotiations on tax coordination at the OECD in Paris, but progress was very, very slow. And one of the consequences has been that large countries, including the US, for example, started to introduce unilateral measures to recoup some of their tax losses, but that small or poor countries were not in a position to do this and felt overwhelmed by this process. The larger countries introduced digital levies, I mean, Google taxes, as they're sometimes called, and also, for example, the US extended global tax jurisdiction to be able to tax its own companies, US headquartered companies, all across the world in the 2017 tax reform, something called the GILTI, which is a process by which the overseas income of US firms is taxed in the US. But the trouble was that these measures were inconsistent and they overlap one over the other, and that small or poor countries didn't feel in a position that they could actually do this unilaterally in the way that the big countries have done. However, due to a lot of campaigning, the European Commission between 2021 shifted its position and agreed to mandate country-by-country reporting. That is to say, that corporations operating in the European Union would have to report not only their activities in the EU, but also worldwide, country by country. So it immediately then becomes obvious where they are not paying tax. Secondly, the US Treasury, under the new administration, said that it would engage robustly to address the tax challenges of digitization and would support a robust global minimum tax. And thirdly, the UN proposed a 25% minimum tax and also a new global tax convention, which of course doesn't exist at the moment. The 25% minimum is, as I said, what the ICRIT have been arguing for some years beforehand. Well, the results so far have been interesting. That is to say that in the late 2021, at last, in the OECD, 180 odd states agreed in what's called the inclusive framework on new rules on where tax should be paid in a fundamentally new way of sharing tax and rights between countries. What this new system is that the leading firms at the moment, those with over about 700 million of sales, would have 25% of their excess profits, that is their profits over and above the normal rate of return, will be reallocated from between countries according to the amount of sales that the company makes. In other words, that 1/4 of Google's excess profits will now be allocated according to the country where people actually use the services rather than in Luxembourg or wherever they had to put it. That's what's called Pillar 1. And in Pillar 2, there'd be the application of a global minimum tax to address base erosion, that is, people shifting their profits around by multinational enterprises. This will apply to all companies with sales of more than 750 million, which is a lot for us, but it's quite low internationally. And in effect will allow countries, if they find that firms headquartered there or operating from there are shifting their profits abroad to countries which are charging less than 15%, then the balance can be recouped by the other countries. So that in effect forces the global tax rate up to at least 15%. Now, this result has been in part from pressure from tax agencies in the large or rich countries who have been losing most out of the current process, but also, as I said, by campaigning from global civil society on behalf of the small and poorer countries. So it was a sort of alliance, if you like, of the devils and the angels, if you like, to get this result. Now, the problem is that the goal, if you like, is very limited, because the OECD estimates that they'll be able to raise about an extra 100 billion a year, which is only a fraction of total avoidance, as we know. The avoidance, as I said, was about 600 billion a year, so there's only a fraction of that is going to be recovered. And the main effect is from Pillar 2, that is to say the global minimum tax, which they're setting at only 15%, while we proposed that it be 25%. Of course, that would have allowed a recovery much larger tax. The second problem is the main dollar gains are to rich countries, not poor countries. Mainly because although the tax rates will now be based on activity, it's going to be based on final sales. And this tends to benefit, obviously, a country with a sales amount, rather than our proposal, which is that the tax would be levied on the basis of where the production took place, or employment, and so on and so forth. So that's a big shift. It also, incidentally, only covers global consumer companies, companies selling to consumers. And so it doesn't really cover primary resource exporters, mining, oil, and so on and so forth. A big consumer. Also, the implementation will be slow, as we said. It will be limited to these very large firms. Another problem is that because of these rules on a minimum tax, one of the instruments that developing countries think they need to have an industrial policy, which is to give tax breaks to firms, particularly industrial firms, tourist firms, building hotels and so on, that will be extremely limited under these proposals. And in consequence, there is some pushback from developing countries on the grounds that they will be not able to conduct a sort of directive industrial policy. The other large lacuna that we have in the system is it doesn't really address the issue of private wealth taxation. This is only large corporations. So the whole question of who are engaged in tax avoidance, but the whole issue of private wealth taxation and thus of tax evasion, people who aren't paying tax at all, has yet to be addressed. And in fact, this is the next task of the Commission, which is now moving on to looking at the scale of private wealth being held abroad and measures to actually effectively tax that wealth. So just looking at the figures very briefly, you can see here that the total gains from the system, the bottom right, what is the OECD, will be as much as 100 billion, as I was saying. Most of this comes from Pillar 2, and so I said Pillar 2 being the reduced, the minimum tax. It would lead to more direct revenue gains, but also there'd be large gains would come from reduced profit shifting, that is, of stopping companies from moving profits to low tax jurisdictions. So there's an absolute effect and a substitution effect, which is quite important. It also includes in the total estimates the US GILTI regime, which is for taxing overseas profits of US corporations. And of course, one of the reasons why politically these proposals became acceptable to the US administration is because they're very much in line with the present US tax policy, which is why the OECD includes the GILTI with their estimates. Again, if we look at this in terms of percentage of income gains, the Pillar 1, that is the reassignment of taxing rights, is in fact larger proportionately for the poor countries than the rich countries, although it's larger in absolute terms for rich countries. It actually represents a larger proportion of tax income for poorer countries, which is a good thing. But on the other hand, Pillar 2, which, as we saw, the minimum tax, which is the larger, or the gains for high-income countries are much, much greater than they are for middle and low-income. So the fact that most of the emphasis will be on Pillar 2, again, is highly criticized from the point of view of developing countries. So it would be easy to be pessimistic about this, but I think there are reasons to be optimistic. The first thing is, you must remember that there's been no system of international fiscal coordination. The last attempt to do anything was with the League of Nations 100 years ago, and even then it was to start to eliminate double taxation and so on. So the fact that countries are now cooperating on taxation, that they are putting an end to tax havens, that they are insisting on minimum tax, and they are considering or will apply methods which will reassign taxing rights to all developing countries are, I think, a big step forward. I think a second lesson to draw from this is that effective advocacy on these issues, not only international taxation, but obviously debt, developing country debt, or fair trade, or anything else, does have to combine political pressure with technical expertise, that one or the other alone is not sufficient. And a third lesson I draw from this is that there are, St. Anthony's can claim to have some input into this process, and I think that Warden would agree with me, there is a real sense, and this is what St. Anthony's is about. Thank you. Over to you, Rodrigo.
Thank you very much, Valpy. Thank you. And yes, I think everything that has been said about Valpy is of course absolutely true. But I would just like to add a couple of anecdotes. First of all, when I came to Oxford, Valpy was well known for his wit, and many people told me, "You got him as your supervisor. Good luck. He's tough." But in the end, I realized, beyond that extremely sharp intelligence, there is also an extremely generous human being, and that prevailed throughout his supervisorship. And I will forever remain grateful to Valpy for that. It's the human being behind that Oxford professor and sharp intellect that really made the difference to me. And the second thing is I joined Oxford and St. Anthony's in the fall of '97, and as you might recall, that's when the Asian financial crisis was raging on. And so I remember one of the first seminars I attended at St. Anthony's actually was on the Asian financial crisis, and a fellow, I don't remember who it was, some chap was delivering his presentation, and Valpy was hard at work marking exams, and I thought, well, Valpy's not really paying attention. I kept looking at him, and he was just very busy making notes, to the papers he was marking. And then at the end of the presentation, Valpy is the first one to raise his hand, and I was surprised. And I said, well, what is he going to ask? He barely paid any attention. Well, he started questioning even the mathematics of the presentation, let alone the substance. He said, in that equation, you have something wrong. And then he started getting to the details. And I was, that's just what tells you, something that tells you how sharp his intelligence can be. I was just impressed. And multitasking seems to be something that Valpy manages very well. I don't. But in any case, thank you, Valpy, for everything you taught us at St. Anthony's, at Oxford. And thank you so much for everything you taught me. I will forever remain grateful. I will share a presentation briefly, just commenting on Valpy, and for that, Valpy, you need to stop sharing the screen. And yeah, can you see it now in presentation mode? Yes. Okay, fantastic. So very quickly, I'll refer to the issue at hand and the response, and assessment of that response, which is the inclusive framework, and then perhaps other considerations for the path forward. And this is by way of comments on Valpy's excellent presentation. And thank you so much, Valpy, once again for the presentation. So the issue, of course, is, as Valpy mentioned, the global race to the bottom in corporate income tax that we've seen over the last 40 years. Why have we seen that? Well, of course, because of the greater degree of international capital mobility that we've seen precisely over that period of time. And that in turn is the result of liberalization policies, what we call globalization, but also technological changes that have allowed companies to become a lot more footloose across the globe. There are, and we have to say, however, some deglobalizing forces right now. And so this process may not be in full reverse, but certainly may be somehow undermined by geopolitics, exacerbated by the pandemic. We can talk about that in the Q&A. Now, the issue here is that, of course, cutting corporate income tax rates may be the rational strategy for countries individually considered in the face of competition. But we know that that is globally suboptimal, and this is precisely the coordination failure that Valpy pointed out. And so resulting from this coordination failure, we get enormous revenue losses from the profit shifting that disproportionately affects emerging markets and developing economies, and particularly as a share of GDP. And this is something that is at the crux of what Valpy is presenting today. Now, of course, we know the global competition is there and is creating a lot of downward pressure on tax rates. Now, I would just extend Valpy's comment on the fact that global competition for foreign investment is creating this process. I would say that it's actually all investment. That includes also domestic investment and what we may call expatriate investment. That is the investment that may come back to countries from capital has been exported by residents beforehand. So there is a lot of expatriate investment from low-income countries that has gone to advanced economies. Some of it may come back, but will not come back if the conditions are not right. And so there is also competition to attract expatriate investment, as well as retaining and perhaps promoting domestic investment. So that is also there. And that is more relevant for large firms. It's not so relevant for SMEs. Small and medium enterprises will face greater hurdles for mobility across borders. So that is not so much an argument for smaller firms, but certainly large domestic firms will be a consideration when countries engage in this race to the bottom. In any case, it is true that low-income and middle-income countries are more reliant on foreign investment than others, and therefore more vulnerable to this race to the bottom. Now, a key question here is also how has this race to the bottom affected different countries? We've seen rates falling for all countries. In fact, when we look at Valpy's charts in the presentation, they have fallen in percentage points a lot more for advanced economies than they have for low-income countries. Now, the question is, are LICs more vulnerable? And of course they are, because they are, as Valpy mentions, more reliant on foreign firms and on tax incentives for investment. And one question is, if that is indeed the case, why is it that there's top CIT rates have fallen by less than in advanced economies, as the chart clearly shows? Now, this is a technical issue, but I think Valpy, perhaps one important issue to focus on here is not so much the top CIT rates, but the effective rates, because many of these low-income countries actually rely a lot for attracting foreign investment on free trade zones, where the effective rate of taxation for this company is actually zero. So, for those countries, the top CIT rate may actually provide a misleading picture of taxation on investment, not just on foreign investment, but total investment. That the effective tax rate on investment for low-income countries may be actually a lot lower than painted by that chart. And I know it doesn't come from me; it comes from the IMF, my former employer. So it's I'm blaming the IMF, not Valpy. Now, the policy response, Valpy already referred to it, and I'm not going to go into it. But there are, as Valpy mentioned, some problems with the inclusive framework, which has been the proposal put forward by a group of countries within the OECD and beyond. One is that, as Valpy mentions, the tax rise are based on the destination sales, and that, as he did clearly say, unduly benefit rich countries. Now, one question, Valpy, to you, and you may want to answer it in the Q&A, is that chart that you're showing, and I'm not clear, that shows that revenue benefits go mostly to advanced to high-income countries, not so much to low-income or middle-income countries. Is that based on the share of global CIT revenue? That seems to be that's what the chart says. But that may actually mean that it's not so bad, because of course we know the global CIT revenue in absolute terms goes mostly to advanced economies. So if the issue is sharing these benefits proportionally more as a share of GDP or as a share of the revenue of the particular group, say low-income countries or middle-income countries, then perhaps this proposal will still be progressive in the sense that the revenues would be accruing proportionally more to lower-income countries, and that would be desirable. But that is a question that perhaps, Valpy, you may be able to dispel. In any case, as Valpy suggests, the allocation may not be entirely efficient, and I will venture to say not entirely fair, given that it is based on sales and destination sales. As Valpy insists, this should be based on active economic presence, and that may be value added, it may be wages. In both cases, I would say it should be PPP adjusted, that is adjusted for the differences in cost of living, or it may be based on actual employment numbers. But in any case, something that refers to the effective economic presence of the companies and not so much where the sales take place, because that may actually benefit countries in the north as opposed to developing countries. Also, one key problem for this inclusive framework is that the rate proposed is 15%, which seems to be low indeed, lower than even the rate for Ireland, and something that may not fully actually prevent the process of global competition, particularly race to the bottom, because many countries have CIT rates that are still above 15%. So there is still scope for a race to the bottom that is not, or at least a race to the 15%. So it is not a rate that seems entirely desirable. And finally, as well, we mentions the IF, the inclusive framework, does not address wealth taxation. And I may say also, it doesn't address personal income taxation, which is also a critical omission. And it's not easy, but I think going forward, this should be amended. Now, also there are benefits, of course. This is a major step forward, as Valpy says. May I say perhaps a first step in international cooperation in global taxation. And I think it's particularly important to highlight not just the outcome, but particularly the process, because it's a process of cooperation at the global level. And I think that is critical to solving a lot of problems going forward. But this is certainly a very good precedent for solving this global coordination failure that we've been referring to, and Valpy clearly highlights. And of course, we owe that major step forward to the Commission, and of course to Valpy and his work. So this is also a way of recognizing his work that is not just restricted to this and his participation in the Commission, but as both Roger and Diego mentioned, has been going on this issue of global taxation for quite a few decades. Well, he started probably in kindergarten. I don't want to refer to his age, but certainly it's been going on for quite a while. I would say that it may be the revenue benefits for developing countries may be smaller than a better system would provide, but certainly there would be additional revenue to LICs, and that will allow for a much needed fiscal expenditure on different areas. In fact, it may even allow for industrial policy. Valpy is concerned in his presentation about the structure of this inclusive framework, perhaps constraining unduly LIC's industrial policy. I think that perhaps there will be revenue for things that are critical for industrial policy, particularly strengthening fundamentals to promote investment, foreign and domestic, health, education, infrastructure, the rule of law, and perhaps to meet some of the challenges of today. We know that there are a lot of resources that will be required for this, but we are facing challenges, not just the pandemic or the stagflationary shock that we're facing globally as a result of the invasion of Russia to Ukraine, but also climate change and demographic change. All of this, at least some of the resources that will be provided by this inclusive framework may go to solve partially some of these challenges. And also support industrial policies where we have learned they tend to be most effective, particularly, and I say this from the experience of Costa Rica. Diego knows a lot about the experience of Costa Rica, so he may actually want to chip in. But I think where industrial policy has been most effective in our case has been advisory service to overcome information barriers, to attract foreign investment and to promote domestic investment. Barriers to entry, risks that are difficult to foresee for companies. This is where actually the state has an important role to play, and also coordination issues that are forbidding when it comes to exporting or attracting foreign investment. And so in general, I've seen also the role of export and investment promotion agencies in Costa Rica as providing a bridge for diversification, because they actually help companies make the jump from the production of existing products to adjacent activities, and that is important in diversifying products and markets. And then also for cluster formation, the state participation is critical in all this. And the point is that I think the inclusive framework will provide much needed revenues for all of that. Now, going forward, I think, and I would like to see this inclusive framework as a first step. There should be more efforts to improve it. And perhaps two guiding principles that would help improve it would be the well-known principles of global taxation, capital export neutrality, meaning that residents of the same country are subject to the same rates, so that that ensures that location decisions by multinational companies are based on fundamentals and not on tax differentials. And then capital import neutrality, which means that investors in the same country are subject to the same tax rates, which ensures that competition among companies in the country are carried on a level playing field and not based on tax advantage. So in general, those principles tend to do away with tax arbitrage globally. So based on those principles, I think the inclusive framework should seek in future, and we hope that Valpy will continue to push the ship forward in that direction, is that there should be 100% tax crediting on foreign corporate income tax paid to avoid double taxation. That would ensure or help ensure capital export neutrality. And then have all countries give national tax treatment to foreign investment, which would help move in the direction of capital import neutrality. And then there should be, of course, proposals for a global approach to personal income and wealth taxation, which I think are critical. Well, we already mentioned that. More broadly, I think, and this refers to something that Diego mentioned briefly in his presentation, there should be still, and I hope Valpy, you may revive it, scope for something akin to the multilateral agreement on investment that you so much helped push for back in 97, 98, when we worked on that project, which of course I have unforgettable memories of. I participated in that project. Indeed, I was a co-author of that paper. But Valpy, maybe there is still scope to do that. And mainly that multilateral agreement on investment was seeking to provide for a level playing field when it came to rules for attracting investment, so that there will be more certainty for companies operating globally, and that would help at the margin developing countries attract that much needed foreign investment. So I think there is still scope for that, and I hope that as part of this effort, we go beyond mere taxation and go to other rules that the multilateral agreement on investment or was seeking to promote. Thank you so much, and with that I stop. Valpy, thank you once again for your excellent presentation. And here, perhaps the first order of business is to pass it on back to Valpy if he wants to refer to any of my comments, and then we perhaps can open it up the floor to questions. Valpy.
Thank you, Rodrigo, partly for your personal remarks. As everybody here has guessed, you are one of my outstanding students, and so much so, in fact, that you also lectured on international finance to our students, and also on Latin American economics to the students. So it's really good that you have these remarks. Turning to what you were saying, firstly, you're saying that it's important to see that this isn't really just about foreign firms, but it also affects domestic firms who come under the similar tax regime, and the great importance of expatriate capital. So I agree with you entirely. I think an idea we tried to introduce into the negotiations that failed was to try and distinguish between large and small firms. And this comes back to your point about learning, which is very much about small firms. Now, of course, proportionately, the foreign investors tend to be much larger than the domestic firms, so that some form of discrimination may be justified on the grounds of, programs to promote small enterprise, right, would be one way of countering the discriminatory effects of concessions to large firms. The second point is that as you mentioned, the headline rates, the ones that are quoted here in the tables, are not the effective rates, because the effective rates, of course, obviously include not only the profit shifting by companies themselves, but also, as you said, the tax concessions given investment incentives and so on. To date, it's been quite difficult to get data on what comparatively effective rates, because we've only had data for US firms abroad. But now, as the new regulations under the agreement will require country-by-country reporting by all firms, we will actually be able to track what the effective rates of taxation are. And I think you're quite right. They will turn out to be even lower in emerging markets than they are in advanced markets. So that when the data will become available, and one of our problems and one thing we've campaigned for is the fact that the data generated in this process is still proprietary to the government, so it's not shared internationally. So it's very difficult for campaigning groups or researchers to actually use effective data. And this is also a problem for smaller, particularly poor countries who may not have the capacity to use the data or access it properly effectively. The point I wanted to make, and I think you underlined it, the need for example, allocations based on not just on sales, but on employment, for example, wage levels and so on. I agree entirely. But I think it's worth remembering that ever since the 19th century, the taxation within the United States, the allocation of tax between the different states of the Union, has been based on something called the Massachusetts formula, which basically started because of the railroad companies operating in lots of different states at the same time. Is based 1/3 on the capital stock in a particular state, 1/3 on the employment and wages, and 1/3 on the sales. So that these are not sort of strange ideas we've just invented. These are ideas that are intrinsic to any federal system, must have this allocation. So what this implies, in a sense, is a step towards some sort of federal approach to international tax and so on, which I think has a hidden possible benefit, although you may think I'm over-optimistic, which is the idea that, in a sense, we could replace development assistance with some sort of fiscal sharing process, just as much as within a particular country, there is fiscal sharing between the richer and poorer parts. So in the long run, I would hope that sort of fiscal cooperation would actually allow the world to move away from a system based on charity or geopolitics towards a system based on fiscal entitlements, opposed to tax, and also fund sort of basic needs of health and education and so on. And exactly the same system happens within the UK or within the US or within Europe or anywhere else. So I'm quite optimistic in the long run. I think there will have other problems. Thank you very much, Rodrigo. And way back then, I mean, 30 years ago, you were needling me and pushing me and making me work harder. And I can see you're still trying. Whether you'll succeed is another matter.
Thank you so much, Valpy. And may I say, this presentation and your extremely insightful comments now are just a signature Valpy, which has always been an excellent mix of microeconomics and macroeconomics towards the solution, the understanding and the solution of practical issues, particularly for developing countries. In a world where we know that economics has become so abstract, in many cases, so detached from reality, Valpy has always been a contributor to solving real problems with good theory, and that is what I call signature Valpy. This presentation, Valpy, and your comments just now are an excellent testimony to that. And thank you so much for that. We have actually 3 questions in the chat. Let me perhaps ask the first 2 of them, Valpy, if you want to take them. The first says, and is by Arthur Olszewski. He says, how would you square the aims of Pillar 2 with the desire of certain developing countries to offer targeted preferential tax regimes in order to attract investment? That is question number 1. Question number 2 is by Dylan Baker, who was actually an alumnus of mine, a student of mine here at Oxford when I was a university lecturer in Latin American economics. Dylan is asking, with global collaboration at the heart of the global tax minimums, ability to improve optimal economic outcomes, does such an approach perversely incentivize rogue states not participating in mainstream global cooperative efforts to become tax havens, tax evasion enabling hubs, and thus perhaps benefit their particular dangerous aims? That's a slightly long question, but I hope you got it, Valpy. If you want me to repeat them, please let me.
I've got it in 2 parts. The first one is, yes, it's a considerable concern of developing countries, and we've been working closely with the G24, which is the representative group of developing countries for the bank and the fund on this issue, that they're very concerned by their ability to offer tax incentives. I think there are 3 issues, practical issues that have come up here. The first one is the administration of tax incentives inside the country, most countries, is a bit difficult because this is not the Treasury or which is giving these tax incentives. These are usually handed out by the ministry or even the presidency when they're negotiating foreign investment, so that it doesn't seem really under control, right? And that, the president will just say, we've received a delegation wanting this, and they've demanded tax incentives, and we've given it. So there is a question of domestic coherence. And in our opinion on the Commission, one step towards the coherence, political coherence, would be that countries should publish in their budget the full tax costing. In other words, that the budget should show the tax concessions in it, right, as lost revenue alongside the revenue estimates, so that people could see that, for example, for purpose of argument, more money would be given out in tax incentives to foreign investors than was being spent on primary education, whatever, so that this would be an important process. Because at the moment, it's sort of under wraps, secret. The second point is that the incentives should only be real investment, right? And physical investment or investment in technology and so on, and not just a tax holiday for any investor coming to do anything. And the third point is that, of course, the tax concessions should be conditional or ex post rather than ex ante and unconditional, as they are at the moment. But precisely the negotiations at the moment in Paris are about these carve-outs, about how to define these rules and how to legislate for them in the international agreements. So a lot of work to be done, but I think we have to press on making sure that they are all real investment. The second point was, would this enable further tax havens? Well, no, it's the reverse, because the whole point of both Pillar 1 and Pillar 2 is that it makes it much less attractive to multinationals to park their money in tax havens because they're going to get taxed anyway, right? So that the mechanism is self-enforcing. If we want to go back a bit historically and look at this, the original proposals from the UN and so on and so forth, the Monterey agreements and so on, had been that what we really needed was an international tax authority, sort of UN agency which would collect tax and redistribute it. This is just politically a non-starter. And the whole idea has been to design a system that's self-enforcing. That's to say, the fact that as long as, let's say, the major, the US and the EU in particular, start applying this system, then other countries will, the tax havens will lose their funds, whether they like it or not, unless, of course, they raise their tax rates up to the level of 15%, in which case the multinationals will have no particular incentive to take the money there at all. I think, I don't think this system will lead to more tax havens, rather the reverse. I think it will dry up the ones that already exist. But of course, the tax havens also exist for personal wealth, which isn't affected by this at all. But it's another matter.
Thank you very much, Valpy. And there was a second question by Artur Olszewski, the third question, and with that, perhaps we should close. The question is, in light of existing mechanisms such as the Common Reporting Standard or FATCA, what else could be done to improve global tax transparency in the personal income tax space? Perhaps, Valpy, you could provide a short answer and then we bring it to a close. Thank you very much.
Personal income tax or corporation tax? Personal. So the question.
Personal income tax, yes.
Oh, yes, quite another issue. You can't really clamp down on personal income tax unless you have, unfortunately, some sort of global asset register. You can find out where people are holding their money, right? This is much more complicated than multinational corporations, which do generally not engage in tax evasion. They engage in tax avoidance. That's to say, they do produce accounts where they're headquartered, and they do show where they're being taxed or not taxed. Personal income tax is very, very different. As I said, I personally have an alternative proposal, which would be a withholding tax system. In other words, that if you, let's say, have shifted your assets overseas, but then want to spend money in your own country or make transactions with those accounts, then there should be an automatic withholding tax of 25% on transactions with those localities. Basically, this is what happens within Europe, for example. I mean, if I go and give a lecture in Spain, I should declare this to the Inland Revenue in the UK, but the Spanish authorities offer me an alternative of either paying 25% tax on the spot there, or of showing the documents where I have declared my income to the UK tax authorities, in which case they'll let me off. So in practice, I have to pay a minimum 25% tax, even though I'm not declaring my full income in Spain, and vice versa, the other way around. So a withholding tax system, I think, would probably be the best system, short of having a global asset register, which would be a good idea, but is very difficult to see.
Thank you so much, Valpy. Those are brilliant answers to these difficult questions, and thank you so much to Dylan and Artur for posing those questions. So with that, we bring it to a close. I think, Roger, I would like to pass it on to the warden, perhaps for a final word, if that is appropriate. For those of you who want to join me in virtually applauding Valpy's presentation, you can do so by going to reactions, and then you will see where you can join your hands in a clap, in a virtual clap. So thank you very much, Valpy. Perhaps warden, back to you for a final word.
Well, thank you very much indeed. In fact, I'm going to give the final word to Walter, who will announce what I think is a really exciting venture, which is a new scholarship that we're setting up very much with Valpy in mind. So, Walter, do you want to tell us a little bit about the scholarship scheme that we're setting up?
Yeah, so a while ago, Valpy got in touch with the warden, Roger, and with Diego, suggesting that we send up a joint college department scholarship that supports students from Latin America who are taking a degree at the department and with their college choice, St. Anthony's. The aim of the scholarship will be to cover the cost of all the academic fees. The good news, that's of course very expensive, but the good news is that we have already a very generous donor, and that's Valpy, and his giving is matched by the department. And what we need are, you all and Valpy's former students to support this scholarship by, and we need a further 5,300 on an annual basis. It would be wonderful if you all could help at a level that you're convenient with. And I hope you don't mind. I will get in touch with you in the next few days to tell you more and to give you the details for how to support this very good joint St. Anthony's audit initiative. And thank you, Valpy and Rodrigo, for taking the time tonight to be with us.
Let me add my thanks also to Valpy and Rodrigo for a fabulous, and as an anthropologist of Japan, I suspect I was the person who learned the most on today's presentation because I had the most to learn, but actually I hadn't realized just how much I actually was aware of these issues and these debates and the role that you have played, Valpy. So huge thanks to that, and huge thanks to Rodrigo. And may we all meet up in St. Anthony's as soon as possible in person. That would be such a nice thing to do. So we look forward to seeing as many of our comrades, friends, and alumni back at St. Anthony's as soon as you can, and we can celebrate so much. But thank you so much indeed to everybody who participated in the event this evening. Huge thanks. Thank you very much indeed.
Thank you very much, all of you, for coming and listening and not falling asleep. And it's nice to see many faces, particularly Peter and Nadia there as well. So I'll hope to be in contact with you soon.
Lovely. Thank you so much.
Bye-bye.
Thank you very much.